Murphy's Law? Anything that can go wrong will go wrong. We can't control life, and we can't see what's coming. That's why John decided to get a whole life insurance policy, and Sarah realized that term life insurance is a better fit for her needs. Both options are great, but this video will go through a detailed comparison to ensure that you are picking the most suitable option for you. It's better to improve your knowledge and make an informed decision instead of being persuaded by a financial advisor to take one option or the other. Financial advisors may have a great conflict of interest since they are ultimately seeking a commission, not your best interest. Make sure you complete this video, and we are confident that you will get closer to making the right choice between whole life insurance and term life insurance. When looking into purchasing life insurance, it is essential to understand the basic pros and cons of both whole life and term life insurance to make sure you take the best decision for you. Good financial decision making is based on solid research and sound advice. Don't let financial advisors do the thinking for you because they only have one word in mind: commission. The commission is what drives them to give you the best advice for them, not for you. Let's start with some basics, shall we? Whole life insurance provides the insured party with a lifetime permanent coverage in exchange for level, regularly paid premiums. In the case the insured party dies, a death benefit is provided for the insurance beneficiaries. The important thing to know about life insurance is that it does not have an expiry date and has the potential to be used as an investment tool. When premiums paid into your whole life policy matches the death benefit, it is considered to have reached its maturity date. Typically, insurance companies design policies to mature when you turn 100, but some recent policies even extend that to 120. Term life insurance, which is sometimes referred to as pure life, provides the policyholder with temporary coverage for a specific term that may range between 10 to 30 years. If the insured party dies within the term, the policy beneficiaries
Did you know that you actually don't have to meet people in person to sell them insurance? You actually don't even have to chase people either. There's a way to get them to come looking for
30 years. If the insured party dies within the term, the policy beneficiaries receive the death benefit. On the other hand, there will be no death benefit if the term policy expired before the insured party dies. Nevertheless, the policyholder can have the option of renewing the term policy or even converting it to a whole life policy that does not expire. Term life insurance comes in several flavors, including convertible, increasing, mortgage, and annual renewable. Each one of these types targets a specific need for potential customers. Convertible term allows the term insurance policy, which typically has a limited number of years, to be converted to whole life insurance before it expires. Increasing term allows the increase of death benefit as the time goes forward. The mortgage term, which is sometimes referred to as the decreasing term, is the exact opposite of the increasing term. It's done in a way that the death benefit amount decreases over time. This is to match the death benefit with the decrease of the policyholder's outstanding mortgage amount. The last type is the annual renewable, which each year renews the term insurance for a higher premium since the policyholder is a year older. The main benefit of annual renewable is that the coverage is guaranteed to be approved every year. When it comes to the main components, whole life insurance is made of premiums, death benefit, and cash value, while term life insurance is composed of only premiums and a death benefit. The main difference is the cash value component in the whole life insurance, which is sometimes referred to as a living benefit, while the term life insurance is not worth anything unless you were to die during the term, and that's when you receive the money. In whole life insurance, part of the premiums you pay goes to building up the cash value which you receive dividends on. During the first 10 to 20 years of coverage, a whole life insurance policy's cash value is quite small due to fees and coverage cost. The insured party should receive around 10% dividends on the cash value only, but when deducting all the insurance company's administrative fees and commissions, the insured end up with dividends around 2.2%, as reported by the Consumer Reports Organization. Essentially, dividends are based on the performance of the company's financials, interest rates, investment returns, and new policies sold. The cash value of your whole life insurance policy will not be taxed while it's growing. This is known as tax deferred, and it means that your money grows faster because it's not being reduced by taxes each year. The beneficiaries are only entitled to the death benefit while the cash value may go to the insurance company. Beneficiaries are usually the family members of the insured party or can even be a company. Nonetheless, the cash value can be accessed by the insured party in case of canceling or surrendering the policy, withdrawal, or even taking a low-interest loan from the insurance company with the cash value as collateral. Unpaid loans and withdrawals exceeding the permitted amount may reduce the death benefit by the outstanding amount. Both whole life and term life insurance requires the payment of premiums in exchange for the death benefit. But due to the different duration of coverage for both policies, the premiums paid for whole life insurance tends to be higher than the term life insurance. We can also say that the availability of the investment component, which is the cash value, makes the whole life insurance premiums more expensive. Let's crunch some numbers, shall we? For example, John decided to get a whole life insurance policy while Sarah realized that term life insurance is a better fit for her needs. They are both 35-year-old, healthy, non-smokers, and wanted to purchase a life insurance policy that provides a $250,000 death benefit. Sarah decided to obtain the term insurance that provides her with coverage for 20 years, while John purchased a whole life insurance that does not expire. Sarah will end up with $20 to $30 per month, while John will be paying around $200 to $300 per month to get this permanent coverage. Yes, that is a huge difference, a 90% difference to be more specific. But it's worth mentioning that John is getting some return on investment with his whole life insurance policy, represented by the cash value dividend. The dividends John will get would amount to 2.2% of the paid premiums, as reported by the Consumer Report Organization. This means John will be getting around $60 dividend for a rather hefty amount of premiums paid. Not a great investment when compared to other options. Getting back to Sarah, when her term life insurance coverage expires, and assuming she would want to renew it, the premiums will most probably hit the roof, since the premiums will be recalculated based on Sarah's age at the policy's expiration date, which would be 55 years old. The other outcome may be that the insurance company can even refuse to convert the term insurance policy to a whole life policy, and therefore Sarah may lose her coverage after 20 years of payment. That is assuming that Sarah has not purchased a non-traditional term life insurance such as the convertible or annual renewable. Make sure to check out our video on different types of term life insurance. This will help you make up your mind even more when making a well-informed decision. So at this point, you should understand how whole life insurance and term life insurance works and how they're different from each other. Which one is the most suitable one for you? Make sure you tell us in the comments. Only you can decide that based on being more knowledgeable about the advantages and disadvantages of each option, based on your unique situation. If you like this video, make sure that you demolish that like button, subscribe, and hit that bell button to receive notifications on our new videos.